What if I told you in 2008, the entire global financial system came down within days, or maybe within hours of total collapse? It's not a recession, it's not a rough patch, it's a complete catastrophic meltdown. And the crazy part? It wasn't caused by a war, a pandemic, or natural disaster. It was caused by houses. Regular suburban houses with white picket fences and two-car garages. So how exactly did the American dream nearly destroy the world economy? Let's break it down. To understand the 2008 financial crisis, we need to rewind to 2000. The dot-com bubble had just bursted and the US economy was bleeding. The Federal Reserve slashed interest rates 11 times down to just 1.75%, the lowest in 40 years. Cheap money flooded the system, and at the same time, both political parties was pushing hard to get more Americans into homes. Legislations required mortgage giants like Fannie Mae and Freddie Mac to approve more loans for lower-income buyers. It's a noble goal, but has catastrophic execution. Banks saw this opportunity and sprinted towards it. By 2004, home ownership hit a record of 69%. To keep that number climbing, lenders stopped asking hard questions entirely. This is where subprime mortgages enter the picture. Home loans were handed to people with bad credits, no credits, or incomes that simply didn't add up. Normally, a bank would say no to them, but in the mid-2000s, the banks wasn't saying no to anyone. The most extreme version was something the industry actually gave a name to. It's called the Ninja Loan. It stands for no income, no job, no assets. You could walk in with empty pockets and walk out approved for $500,000. It sounds like a joke, but it wasn't. The reason why banks didn't care whether borrowers could pay them back was because they never planned to hold on to those loans. Instead, they bundled thousands of mortgages together and sold the package to Wall Street investors as a product called mortgage-backed security, or MBS for short. The bank got its money back instantly from the investors and went straight to writing more risky loans, and rinse and repeat. Wall Street then repackaged those bundles into even more complex products called collateralized debt obligations, or CDOs for short. Think of it like blending a basket of fruit, some fresh and some rotting, and pouring it into a premium bottle and selling it as a health drink. Nobody's checking what went inside the blender. The people whose job it is to check whether these products was good or not, the credit rating agencies like Moody's and Standard & Poor's, were being paid by the very banks whose products they were rating. So they kept stamping AAA ratings, which is the highest mark of safety on what were essentially packages of financial garbage. It was like paying your teacher to grade your own exams. Meanwhile, a shadow banking system had quietly grown outside normal regulations. No oversight, no safety nets, just enormous bets with borrowed money. In 2004, the SEC made it worse by removing caps on how much banks could borrow. Previously, it was limited to 12 times their assets. Some banks stretched now to 30 or 40 times their own assets. Now everyone was getting paid. The lenders, the banks, the rating agencies, and the investors. And as long as the housing prices kept rising, nobody wanted this music to stop. There was one assumption holding everything together though. It was the American dream. Home prices had never fallen nationwide all at once in the history of America. Everyone believed they never would and never will. That belief was about to be destroyed. However, by 2006, a small group of analysts noticed the US yield curve was inverting, a bond market signal that had preceded nearly every American recession in history. A growing minority began saying quietly, then loudly, that this was a house of cards. And they were right. In 2007, home prices peaked and started to fall. Just a dip at first, but millions of borrowers had taken out loans with low introductory rates designed to adjust upwards after a few years. When prices dropped and payments climbed at the same time, they were trapped. Their homes were worth less than they owed. They couldn't sell, They couldn't refinance, so they just stopped paying. Defaulted payments piled up, foreclosures followed, and those AAA stamped CDO financial products that investors worldwide bought had collapsed in value almost overnight. In early 2007, more than 24 subprime lenders went bankrupt. The two Bear Stearns hedge funds imploded under the weight of bad mortgage debt. Banks that had been lending to each other routinely every night suddenly stopped. Nobody knew who was holding how much toxic debt. The credit market, the foundation of the global financial system, began falling apart. By early 2008, a quarter of all subprime mortgages had been defaulted, and millions of homeowners are now underwater, owing more than their homes are now worth. In March 2008, the investment banking firm Bear Stearns itself neared a total collapse, and the Federal Reserve brokered an emergency fire sale, with the JP Morgan Chase bought the company for $2 a share, a company worth more than $170 a share just a year earlier. Then came 2008 September, the most terrifying month in the modern financial history. On September 6th, the government seized Fannie Mae and Freddie Mac, which backed roughly half of all American home loans. And 9 days later, the Lehman Brothers, a $600 billion in asset company, one of Wall Street's oldest institutions, filed for the largest bankruptcy in American history. The government let it fall. The signal was sent to every financial institution on earth was simple. The message was that nobody is safe. The very next day, AIG, the world's largest insurer, received an emergency $85 billion Fed loan to prevent itself from collapsing. This is because its collapse will take every major bank in the world with it. It would have caused the credit market to freeze completely. Businesses couldn't borrow money just to make the payroll. The Dow Jones Index Fund fell nearly 40% from its peak. Trillions in wealth vanished in weeks, and the US Congress rushed through a $700 billion emergency bailout, which is called the TARP, to prevent the entire financial system from going under. About 4 million Americans lost their homes. Nearly 8.7 million lost their jobs. Unemployment hit 10%. Retirement savings gone. College funds wiped out. Families who had done everything right found themselves devastated by a crisis that they paid no part in. European banks collapsed. Iceland's entire banking system failed overnight. Global stock markets dropped 40 to 60%. World trade shrank nearly 10% in 2009 alone. From the 2008 financial crisis, we could have learnt 4 lessons. First, deregulation without guardrails is dangerous. The financial sector lobbied for decades to remove oversight, and when it got what it wanted, it drove straight off a cliff. Second, the watchdog failed. Rating agencies were paid by the banks they were supposed to scrutinize. That conflict of interest poisoned everything. Third, the Fed was asleep at the wheel. Trusting banks to rationally self-regulate when enormous profits are involved is a fantasy. And fourth, complexity is not safety. Wall Street risk models all shared one fatal flaw. They assumed different housing markets wasn't connected. When the whole market fell at once, the model fell apart completely. The recovery was slow and unequal. The Fed cut rates to near zero. Obama signed a $787 billion stimulus package in 2010. In 2010 later that year, the Dodd-Frank Act introduced the most sweeping financial reforms since the 1930s. Stress test for banks. The Volcker Rule, banning speculative bets with depositor money. Globally, Basel III forced banks to hold more actual capital. It took until the mid-2010s for home values and incomes to recover. The stock market needed 6 full years to reclaim its 2007 peak. The 2008 financial crisis wasn't one villain making one bad decision. It was the effect of an entire system. Banks, regulators, Rating agencies, politicians, all making self-interested choices that built a tower so tall and so unstable that when the first brick moved, everything came down with it. Wall Street convinced itself that it had mathematically eliminated risk, but it hasn't. It had just buried it deep enough that nobody noticed it until it was too late. If there's one thing worth remembering, it's that when something financial sounds too good, or too complicated to explain simply, that's not sophistication, that's just a walking red flag.